All right. How's it going, guys? This is Byron Sweeney with Byron Sweeney Insurance Brokerage. I decided that I'm gonna start doing some little small, quick videos on the basic concepts and understandings of insurance, calling it Insurance 101. And what we'll do is just touch on, just basic concepts that some people don't have the understanding of, or they have a lot of confusion. And the first video is going to be about life insurance, and we're going to talk about the contestability clause. We're going to talk about a graded product, and we're going to talk about a guaranteed issue product. And the reason it is because all of those have a common denominator in a 2-year period, but that 2-year period means a totally different thing with those products and the contestability clause. So I'm just going to break that down a little bit, because a lot of people, the first thing they would say is that well, what's the point of insurance? They're not going to pay it until after 2 years anyway. But that's completely false, depending on the type of policy that you have. Now, they do have some that pay in the 2 years, and I'll explain that. Now, we'll start with the contestability clause first. Now, the contestability clause just it means that if a death occurs within the first 2 years and a claim is made, the insurance company has the right to investigate it, meaning that they can dispute, the claim and the death. So just once you make a claim, they have the right to contest it. So what they'll do is they'll usually pull more records than they usually do after the 2 years is complete. So, of course, they won't want the death certificate. They'll want the autopsy. But what they're going to do now is get the medical report as well, and they're going to look through the medical report to see if there's any disputes that they can dispute to basically, either not pay the claim or, well, that's it. They're basically not pay the claim. But that's what the contestability clause is about. It meaning that they have the right to contest it within the first 2 years. That's why when you get insurance and people just steady sit around waiting to get insurance, you need to get it as soon as possible so you can get out that 2-year contestability clause, and that gives you a better chance of that insurance policy paying out with no issues. Okay? So that's what the main thing about the contestability clause. Don't wait around to get insurance, because you want to get out that contestability clause, period. Like I said, so the insurance companies can pay with least issues as possible after you're outside that 2-year period. Now we'll go to what is called a graded policy. A graded policy means that you have some health issues. Most of the time, some companies may or may not cover you, just depending on what type of health issue it is, and if you have a few other health issues that go along with one issue that compounds your health. So what a graded policy means is that you're going to be on a 2-year period, meaning that most companies, unless it's a modified graded product, most companies are not going to pay until after 2 years. But they do have some companies that have what they call as a modified product, meaning that they'll pay a percentage in the first year, and they'll pay a percentage in the second year, and then they'll pay the full death benefit in the third year. Now, it's few companies out there that has that modified product. Most of them are just going to have, your basic products, which is a preferred product, tobacco or non-tobacco, a standard product, tobacco or non-tobacco. Then they have what they call as a graded product, tobacco or non-tobacco. And then very few companies out there have that modified product, and that's up to the brokerage and the agent to contract with certain companies that basically provides everything you need when you're sitting in front of a client, that you're able to get them covered. And no agent should want to write a graded policy unless you absolutely have to. But if you can, you want to have access to that modified product, meaning that they have some serious health issues, but we can get them covered. But we want to make sure that something is paid in the first year, something paid in the second year, and the full coverage is paid after that because they didn't qualify for a regular preferred product or a regular standard product that pays day one. That pays day one. And now we'll talk about what they call as a guaranteed issue product. It's a form of a graded product, but on a guaranteed issue product, meaning that you have serious health issues, the insurance company, they will cover you, but they're covering you based on knowing that you have, major health issues. So you're going to get less coverage for more, meaning that your premium is going to be higher. Now, the thing is, with a guaranteed issue product, the companies that sell them and that issue people with a guaranteed product, the coverage is only going to go up to, you may be able to only get like 15,000 or 20,000 max. A guaranteed issue company is not going to give you 30,000 whole life policy. They're not going to give you 40,000 whole life policy because it is a guaranteed issue product. So like I said, the most it would be, they would be maybe 15 to 20,000, but they will issue that policy, but they would only pay you after a full 2-year period, no matter what, because of those health issues have. Now, they will send you, if something happened within the first 2 years, they will send you your premiums back. All your premiums you paid into it, plus, depending on most of them do like a 10% interest with the premiums as well. So they'll send that back to you. So that's the conclusion of Insurance 101. And like I said, this episode, we just decided to talk a little bit about the basics of life insurance and some terminology that always get confused and they get interchanged. But the only common denominator of them is the 2-year period, but that's it. But that within that 2-year period, they mean a total different thing. Thank you.